Most people think $1,000 is enough for an emergency. The mathematical reality? That won't even cover a minor hospital bill or a single major car repair. If you rely on outdated advice, you are exactly one bad day away from devastating credit card debt and absolute financial ruin. Stop guessing and hoping for the best. Today, let's calculate your exact, mathematically bulletproof emergency number. It is time to build your financial fortress. To calculate exactly what you need, we first have to violently destroy the most persistent piece of terrible financial advice on the internet. The idea that a starter emergency fund of $1,000 is sufficient to protect you. Decades ago, prominent financial gurus popularized the $1,000 emergency fund. Back in the late 1990s, that advice actually made mathematical sense. $1,000 could pay for a full month's rent in most American cities. It could completely replace the engine or transmission in a used car. It could cover a surprise medical bill. It provided actual structural safety. Today, that number is a dangerous illusion. It provides psychological comfort while leaving you completely exposed to absolute financial ruin. Let us look at the modern economic reality. The average monthly rent in the United States is now well over $1,700. A major car repair, like a transmission replacement on a modern vehicle filled with computer chips and sensors, can easily exceed $4,000. A single trip to the emergency room, even if you have premium health insurance, will routinely cost you a $2,000 deductible before your coverage even begins to pay a single dime. If you lose your job tomorrow and you only have $1,000 in the bank, you will survive for exactly 10 to 12 days before you are completely destitute. You will be forced to immediately rely on predatory, high-interest credit cards, instantly trapping you in a toxic cycle of consumer debt that could take half a decade to escape. An emergency fund is not designed to cover a flat tire. It is designed to act as an impenetrable financial moat between you and total catastrophe. It is designed to completely replace your income while you search for a new job. Therefore, your number cannot be an arbitrary flat amount. It must be a carefully calculated mathematical equation based entirely on your specific cost of living. Before we calculate your specific dollar amount, we must explicitly define what actually constitutes a valid financial emergency. This is where millions of people drain their savings entirely by accident. You cannot use your emergency fund as a general slush fund to cover up your bad planning. Let me be absolutely clear. Christmas is not an emergency. It happens on December 25th every single year without fail. It is mathematically predictable. Needing new tires for your car is not an emergency. Friction guarantees that rubber wears down over 40,000 miles. Your annual property tax bill is not an emergency. These are predictable, known future expenses. You must handle them through regular monthly budgeting, often called sinking funds. If you use your emergency fund to buy holiday gifts or to book a last-minute flight to a resort because you found a great deal, you are actively stealing from your own survival net. A true emergency has 3 strict, non-negotiable characteristics. It is unexpected, it is absolutely necessary, and it is highly urgent. Scenario 1. Total job loss. Your company undergoes corporate restructuring, and you are laid off with 0 warning and 0 severance pay. Your income immediately drops to 0, but your obligation to pay rent remains. That is a true emergency. Scenario 2. Major medical trauma. You slip on ice, shatter your leg, and require immediate surgery. You cannot work, and you are hit with massive hospital deductibles. That is an emergency. Scenario 3. Catastrophic property damage. A pipe bursts inside your walls, flooding your first floor, or the engine block in your primary commuter vehicle completely cracks in half, preventing you from getting to work. Your emergency fund is sacred. It is an armored vault that remains completely sealed unless your absolute baseline survival is actively being threatened. Once we understand this extreme definition, we can begin to calculate the exact size of the vault you need. Now that we have established what an emergency is, we need to completely shift how you measure financial safety. Amateurs measure their safety net in arbitrary dollar amounts. They say, I want to have exactly $10,000 in the bank. But why 10,000? Where did that number come from? Does $10,000 cover your life for 6 months? Or does it only cover your life for 6 weeks? Without mathematical context, a flat dollar amount is totally meaningless. Financial masters do not measure their emergency funds in dollars. They measure them in units of time. The universally accepted gold standard of personal finance is holding 3 to 6 months of living expenses in reserve. This metric is not random. It is deeply rooted in macroeconomic data and human psychology. The primary catastrophic emergency that destroys most people's lives is a total loss of income. If you are fired, laid off, or physically injured and cannot work, the clock instantly starts ticking. The average duration of a job hunt in the United States, especially for a specialized or mid to senior level position, takes anywhere from 3 to 5 months. It takes time to update your resume, yes, survive 4 rounds of corporate interviews, negotiate a salary, and wait for that first new paycheck to actually clear your bank account. If you only have 1 month of savings, you will be in a state of absolute blinding panic. You will be forced to accept the very first terrible, low-paying job offer you receive simply because you are terrified of being evicted from your apartment. But if you have 6 months of expenses sitting in a high-yield savings account, losing your job is no longer a crisis. It is merely an inconvenience. A massive emergency fund buys you oxygen. It buys you the time and the extreme psychological leverage needed to patiently find a better job, negotiate a higher salary, and keep your dignity intact. We are quantifying exactly how much time you need to survive. When people first hear the 3 to 6 months rule, they immediately make a massive, deeply discouraging mathematical error. Let us assume your take-home pay is $6,000 a month. Most people automatically multiply 6,000 by 6, and they panic when they realize they supposedly need to save $36,000. They feel completely defeated and give up before they even start. Here is the secret. You do not multiply your income. You multiply your survival baseline. There is a monumental difference between income replacement and expense coverage. Your current $6,000 monthly income funds your entire lifestyle. It funds your retirement investments, your expensive gym membership, your weekend trips, your daily coffee runs, and dining out at nice restaurants. But think about the reality of a catastrophic emergency. If you lose your job tomorrow, are you going to continue putting $500 a month into your stock portfolio? No. Are you going to continue eating at expensive steakhouses every weekend? Absolutely not. When a crisis hits, your financial behavior instantly shifts into extreme survival mode. You ruthlessly cut all discretionary lifestyle spending. Therefore, you do not need to save enough money to maintain your luxury lifestyle. You only need to save enough money to secure your absolute bare-bones survival baseline. By calculating your survival expenses instead of your total income, that terrifying $36,000 target might actually drop down to a highly achievable $21,000 target. You must calculate the exact cost of survival. Nothing more, nothing less. To calculate your true emergency fund, you must first calculate your 1-month survival number. This is the absolute bare minimum amount of money you need to keep yourself and your family alive, sheltered, and safe for exactly 30 days, assuming your income drops to absolute zero. To find this number, we look strictly at a concept called the 4 walls. Imagine your financial life as a physical house. If a hurricane hits, the decorations inside do not matter. The only thing that matters is that the 4 structural walls hold up. Wall number 1 is housing. This is your absolute minimum cost to not get evicted. It includes your rent or your mortgage payment, necessary property taxes, and homeowners association fees. Wall number 2 is utilities. A house is useless if it is freezing cold and dark. This includes electricity, water, gas, heating, and basic internet access, which is mandatory if you need to apply for new jobs and attend virtual interviews. Wall number 3 is food. Listen closely. This category is strictly for essential groceries bought at a supermarket to keep you healthy. In a financial crisis, your restaurant budget drops to exactly zero. Your food delivery app budget is zero. You are buying rice, beans, chicken, and vegetables. Wall number 4 is transportation and minimum obligations. You need basic fuel to drive to job interviews. You must pay your auto insurance, and you must pay the absolute bare minimums on any credit cards or student loans to prevent catastrophic defaults and ruined credit. Add those four categories together. That is your core baseline. Every calculation we do from this point forward will be a multiple of this exact figure. Let us walk through the exact mathematical process of finding your specific number. Look at the data on the screen. Do not guess these numbers. Guessing leads to disaster. You need to log into your actual banking portal and look at the physical dollars that left your account over the last 90 days. Let us build a highly realistic average American example. Step 1 is housing. Add your rent or your mortgage payment. Let's say that totals $1,800. Step 2 is utilities. Electricity, water, gas, and basic internet access. Let's say your average utility cost is $300 a month. Step 3 is food. Look at your grocery store transactions only. Do not include restaurants or bars. For this example, let's allocate $600 a month. Step 4 is essential transportation. This includes your monthly car loan payment, gasoline, and auto insurance. Let's set this at $500. Step 5 is minimum debt obligations, the absolute bare minimum payments on any existing loans to prevent defaulting. We will estimate this at $300. Now we sum it all up. $1,800 for housing, plus $300 for utilities, plus $600 for food, plus $500 for transportation, plus $300 for debt minimums. The grand total is $3,500. This number, $3,500, is your unique mathematically calculated survival baseline. It is the absolute minimum amount of cash you must burn every single month just to stay alive. Now that we have the core monthly multiplier, we must decide whether to multiply it by 3, 6, or 12. Not everyone needs to hoard a massive 6-month supply of cash. Personal finance is deeply personal, and your target completely depends on your specific, unique risk profile. Let us examine the low-risk profile. These are the individuals who only need to target a 3-month emergency fund. You fall into the 3-month category if your life is highly stable and financially agile. First, consider your household income structure. If you are in a dual-income household, meaning both you and your spouse have full-time, stable jobs, your risk is significantly lower. The mathematical probability of both of you being fired from 2 completely different companies on the exact same day is incredibly low. Second, evaluate your employability. If you work in a high-demand, highly specialized field such as nursing, specialized accounting, or certain sectors of technology, and you know with absolute certainty that you could secure a new job within 3 weeks, you do not need to hoard 6 months of cash. Third, consider your housing situation. If you are a renter, your risk is drastically lower than a homeowner's. If the furnace explodes in the middle of winter or the roof starts leaking water, you simply pick up the phone and call your landlord. It is their financial emergency, not yours. If you meet all of these criteria, you take your $3,500 survival baseline and multiply it by 3. Your absolute target goal is $10,500. Once you hit that number, you stop saving cash and you aggressively pivot to investing the rest of your money. Now, we must look at the exact opposite end of the spectrum, the high-risk profile. For the vast majority of adults listening to this, 3 months is simply not enough. The modern hiring process is incredibly slow. You must aggressively build a 6-month reserve, which is the gold standard of personal finance. You are high risk if you are the sole breadwinner of your household. If you have a spouse who stays at home with children and you are the only one generating revenue, your level of responsibility is immense. If you lose your job, the entire household's income instantly drops to zero. You must have a massive cash runway to protect your family from immediate crisis. Homeowners absolutely require a minimum of 6 months. When you own a piece of real estate, there is no landlord to save you. If the foundation cracks, if the entire plumbing system fails, or if a severe storm destroys your roof, the bill is entirely yours and it will easily exceed $10,000. Furthermore, consider your specific industry. If you work in corporate middle management, replacing your exact salary is a notoriously slow process. Statistical data proves that white-collar professionals often take 4 to 6 months of networking and multiple interview rounds to secure an equivalent position. You cannot survive a 6-month job hunt on 3 months of savings. If any of these high-risk factors apply to your life, you multiply your $3,500 baseline by 6. Your ultimate mathematical target is $21,000. That is your absolute fortress of safety. There is a third extreme category, the 12-month emergency fund. This means holding an entire year of living expenses in pure liquid cash. This sounds excessive to most people, and it introduces cash drag due to inflation, but for specific groups of people, it is absolutely vital for survival. Who needs a full year of cash reserves? This applies to anyone whose income is highly erratic or whose risk of total financial wipeout is extreme. If you are a freelancer, an independent contractor, or you work 100% on commission, such as a real estate agent, you do not have a steady paycheck. You might make $20,000 one month and absolutely $0 for the next 3 months. Your emergency fund acts as an extreme shock absorber to smooth out those terrifying drops in income. This also applies to small business owners and entrepreneurs. When the economy crashes, small businesses get hit the hardest. If your business revenues dry up, you still have to feed your family. Furthermore, if you are a highly compensated senior-level executive, the air is very thin at the top. If you lose an executive role paying $250,000 a year, there are very few matching jobs available on the market in any given city. Executive searches routinely take 9 to 12 months to complete. If you do not have a 1-year runway, you will be forced to liquidate your retirement accounts and pay massive tax penalties just to survive the transition. Now that you have multiplied your monthly survival number by your required months, you might think you have your final target. You do not. There is one massive hidden variable that destroys emergency funds faster than anything else: insurance deductibles. This is the hidden trap that traditional financial advice ignores. Let's say you built your 6-month emergency fund and it totals $21,000. You feel incredibly secure. But then the absolute worst-case scenario happens. You are involved in a severe car accident. Your car is totaled, you are hospitalized, and because of your injuries, you cannot work. You have just triggered a triple threat emergency. Your emergency fund is now supposed to pay your daily living expenses, but before your health insurance pays a single penny for your surgery, you must meet your max out-of-pocket deductible. For a modern health insurance plan, that can easily be $3,000. At the exact same time, to get your car replaced, you must pay your auto insurance collision deductible, which is usually another $1,000. On day 1 of the emergency, you instantly owe $4,000 just in deductibles. If you pay that out of your $21,000 fund, you just lost more than an entire month of your survival safety net. To make your fund mathematically bulletproof, you must look up your health insurance max out-of-pocket deductible, look up your auto insurance deductible, add them together, and stack that exact cash amount firmly on top of your total monthly calculation. Only then is your emergency number truly finalized. Once you have calculated your target number, whether that is $10,000 or $25,000, you face a massive logistical question. Where exactly do you physically store this massive pile of cash? Storing this incorrectly is a devastating mistake. There are 3 options, but only one is mathematically correct. Option 1 is a traditional checking account. This is a terrible idea. Checking accounts pay effectively 0 interest, meaning inflation is actively destroying the purchasing power of your money every single day. Furthermore, your checking account is linked to your debit card. If your card is compromised, a thief can drain your entire emergency fund in seconds. Option 2 is investing the money in the stock market or mutual funds. People think, I have $20,000 sitting there, I should make it grow. Absolutely not. Your emergency fund is not an investment, it is an insurance policy. The stock market is volatile. If a massive macroeconomic recession hits, 2 things happen simultaneously. You lose your job, and your stock portfolio drops by 30%. Right when you need the money the most, 30% of it has vanished into thin air. You never, ever subject your safety net to market risk. The only correct answer is option 3, a high-yield savings account, or HYSA. These accounts are offered by online banks. They are FDIC insured, meaning the government guarantees your money is safe. They are separated from your daily checking account, preventing impulse buys. Most importantly, they pay a high interest rate, often 4 to 5%, which acts as a perfect shield, protecting your massive cash pile from the destructive effects of inflation while keeping it perfectly liquid and accessible within 1 to 3 days. Looking at a goal of $25,000 can feel completely paralyzing. How do you actually build this without getting overwhelmed and quitting? You do not save $50 a month. You execute an aggressive financial sprint. Step 1. Temporarily pause everything else. If you are currently investing heavily in the stock market, stop immediately. The only exception is capturing an employer match. You need to redirect a massive, focused fire hose of cash directly into your high-yield savings account. You cannot build the roof of your financial house before you pour the concrete foundation. Step 2. Liquidate your life. Walk around your house or apartment. Look at the electronics you never use, the designer clothes sitting in the closet, the old bicycle in the garage. These are dead assets. Sell them on online marketplaces. You can easily generate $1,000 in your first weekend just by turning physical clutter into highly liquid cash. Step 3. Slash your discretionary budget temporarily. For the next 6 months, go on financial lockdown. Cancel every single subscription service you do not strictly need. Stop eating at restaurants entirely. Take the $300 a month you were spending on dining out and automatically route it to the vault. Step 4. Automate the behavior. Do not rely on willpower at the end of the month. Go to your employer's payroll portal and set up a split direct deposit. Instruct them to send 10 to 15% of your paycheck directly to your new high-yield savings account before the money ever touches your checking account. If you never see the money, you will never be tempted to spend it. Treat the funding of this account as the most critical, non-negotiable monthly bill in your entire life. In the modern economy, relying on a $1,000 emergency fund is financially reckless. It leaves you entirely exposed to the brutal realities of inflation, medical costs, and volatile job markets. Disaster in life is not a matter of if. It is entirely a matter of when. Cars will break down, roofs will leak, and recessions will eliminate jobs. That is mathematically inevitable. Hope is not a valid financial strategy. Preparation is the only defense. You now know the exact formula. You calculate your bare bones, four-wall survival baseline, housing, utilities, food, and transportation. You assess your personal risk profile. Are you a single renter who only needs 3 months, or are you a homeowner with a family who absolutely requires a 6 to 12-month fortress? You stack your deductibles on top of that number, and you park it all in a high-yield savings account. Do not wait for the emergency to happen before you start preparing. If you wait for the storm to arrive before you start building the roof, you have already drowned. Take 30 minutes tonight. Let's look at the numbers, look at your absolute baseline expenses, and find your exact survival target. Start building your financial fortress today and buy back your peace of mind.